Hello, and welcome to CAP STRAT this week. 2024 Outlook season continues. Today, we'll be talking about the Fed.
Yes.
Pretty important input into any type of economic or market outlook you want to put together going into 2024. So we'll talk about what the Fed's looking at and what we think the potential path of monetary policy could look like into next year. But we'll start with market performance. We'll start with equities. Continues to be a lot of green on this page. Mike, any comments from an equity perspective?
Continuing to drift higher, small caps still seen as the winner in this rally we've seen since November 1st, which is quite a bit different from prior rallies we've seen during this market cycle, which those other rallies were dominated by large caps. These, large caps are participating, but small caps have definitely been the outsized winners thus far. And in other areas of global equity markets, we're seeing different participation than we've seen in prior rallies in this cycle. Foreign currencies doing really well. Emerging markets up 7.5%. Foreign developed markets up over 9.5%. So this rally has been a little bit different from the prior rallies. What's been the same is that it's been a rally in everything.
Right.
Yeah.
So you look at fixed income since 11/1 and almost just as strong a green on the fixed income side.
Exactly, and that's where the everything comes in. Stocks and bonds moving in the same direction. Long-term treasuries up 11.5% since November 1st, keeping pace with equities. And these gains that we've seen in the treasury market since November 1st, bringing the year-to-date return for most treasury indices back into positive territory.
Yeah.
The 10-year right now, year-to-date, down 2 basis points, trying to avoid the third consecutive year of losses, calendar year of losses, which would be a record. So right there on the cusp of that.
And so with this rally being a little bit different than what we've seen even during the tightening cycle, why is that? What's going on here?
Yeah, at various points since 2022, the market has been pricing in different things, right? As the inflation picture evolves, the Fed picture evolves, the economic growth picture evolves, et cetera. Right now, since November 1st, we think we're moving into a new regime. It's what we would refer to as the immaculate landing, meaning, the pathway to defeating inflation is in sight, which is crazy to say given where we were in fall 2022, looking like it was going to be a really long, strenuous task to get inflation down towards the Fed's target. And immaculate in terms of, that inflation could get down to target with very little to no repercussions on the major elements of the economy, like the labor market, for example. That's also something that nobody would have fathomed in 2022. Right. It seems so far away, and it seemed like the only way to get inflation down was through a recession. So now that sort of the landing strip is in sight, if you will, and the economy is hanging in there, the market can price in something like an immaculate landing. We think it's a bit irrational, which is what the market has the right to do at times, behave irrationally. It doesn't necessarily mean that every market participant thinks this is going to play out, but they think that positioning for this could result in making money, right? So that's where you see the more inclusiveness of this rally, smaller caps, lower quality areas that have struggled so much since 2022, companies with high debt. That's where you see them rallying this time around.
Gotcha. Yeah, and obviously, we've got quite a bit of economic data coming here near term. How can the market digest this? If we're pricing in the immaculate landing, can the landing get more immaculate? How does that work?
Yeah, well, in our view, the immaculate landing is fairly priced right now. And there are about 9 economic data releases coming over the next week and a half that could very easily turn us back into something more like a no landing, where stocks and bonds are selling off simultaneously, or even potentially a hard landing where bonds do well and areas of the stock market sell off. It's very unlikely that, all the data sort of threads the needle, right, and is very Goldilocks and continues to support this rally that we've seen across asset classes since November 1st. Highly unlikely that happens.
Yeah. So not only is there and it's not even really a high bar, it's threading the needle between being too hot or too cold.
We've had some questions and some comments in financial media about how generally disappointing fixed income has been not only one from a return perspective, over the past 2 years, negative returns, but two, lack of diversification benefits, right? Really, since this tightening cycle started in March 2022, stocks and bonds have pretty much been moving in the same direction, stock prices and bond prices. So not really getting that diversification benefit from bonds when stocks are selling off. And, the reason for that, in hindsight, obviously, is stocks and bonds have two common enemies. They have inflation and then the Fed's reaction to that inflation. And when those enemies are making progress, right, and advancing, stocks and bonds sell off simultaneously. And when those enemies are sort of receding, then stocks and bonds get a relief rally. And so if you look at something like rolling correlations of stock prices and bond prices, they've been positive, at times close to 1, since 2022, meaning bond prices and stock prices moving almost perfectly together. The only time where they started to move in opposite directions was in March of this year,
Right.
when banks were failing and there were very legitimate recession fears being reflected in the market. That's where you saw bonds do very well and more than offset losses from the stock side of a normal diversified portfolio. So, a lot has been made about that. Going forward, now that inflation is coming down and the Fed, you can argue as we get into 2024, is no longer going to be as much of an enemy, right? They're going to go from hiking to a pause phase and then cutting, most likely, that there's room for stock bond correlations to flip back negative and portfolios to behave more normally. And if the economic growth data cools too quickly and there are bumps in the road, we think in 2024 is the year where fixed income is going to do its job very well. Not only are you getting very attractive yields, but you're probably then going to get diversification benefits where you can potentially offset stock losses.
Yeah, absolutely. So potential for that diversification benefit to come back under kind of a couple of different scenarios. It doesn't necessarily need to be a banking crisis with a recession accompanying it.
Exactly.
Yeah.
Yep.
All right. Well, we can check in on the diversifiers since 11/1, potentially, particularly energy being down about 12%. Any other comments we want to hit on in terms of alternatives?
The only other comment here is global REITs performing very well since November 1st. That's just one more asset class that hadn't participated as much in prior market rallies during this cycle and is now sort of leading the way, generally seen as lower quality, highly indebted companies by nature or by definition. And so seeing them rally, that really cements the idea that this rally since November 1st, it's been a little different than the prior market rallies.
Yeah.
Unsustainably different.
Unsustainably so.
Yep.
Yeah. So let's get into that, common enemy, hopefully potentially likely to become a common friend in 2024, the Fed and their reaction function. So what we're looking at here is the effective federal funds rate, up until last weekend, and then looking at expectations for the federal funds rate going forward in the dotted line here. We've, of course, put around that the middle 50% of forecasters around that federal funds futures, and then highlighting here FOMC meeting dates and, of course, the Jackson Hole Symposium, which the Fed has kind of turned into a opportunity to really hammer home and or move the goalposts for monetary policy decisions. What are we looking at here? What's important for us to digest from this chart?
Yeah. A couple things to note as you look into our outlook and our forecasts here in the dashed line. We think the Fed is going to come into 2024 thinking the biggest mistake they want to avoid is cutting rates prematurely and potentially reinvigorating inflation, undoing the progress that they've made, and reliving the 1970s. That's still an error that they want to avoid at all costs. And if they want to avoid that error, it's going to introduce a higher probability of the opposite error, right, which is leaving interest rates too high for too long, or potentially if the economic data starts to slow dramatically and they are reactively cutting, those cuts being too little too late or disappointing for the market.
Right.
So if there is a policy mistake in 2024, that's where we think the mistake is going to come from, right? if we just look at our base case, which does not include a recession as of right now,
Right.
what we would see is the Fed holding the Fed funds rate steady through the June meeting. June meeting will be a quarterly meeting, meaning at that point they can recalibrate their economic growth and inflation forecasts. At that point, we think core CPI will be within shouting distance of their target. And they're probably going to look at the data at that point and their projections and say, we're currently at 5.25% to 5.5%. We need to start making progress towards the neutral rate in order to avoid economic growth getting too cold, right? And having to cut reactively. So at that point, we think they would communicate starting at the next meeting. They'd start to prep the market for cuts, and they would want to deliver a very methodical cutting cycle message to the market, meaning we're going to cut rates at our typical pace of policy adjustments, which is 0.25% at every meeting, starting at the July meeting. And that would get them back down to their neutral rate of 2.5% in 11 meetings,
Right.
thereabouts. So take them a year and a quarter to get back to neutral. So that's sort of the base case. If the economic data cools rapidly, in the near term, say we're staring weak labor market data right in the eyes in January or February at a time where inflation is still constraining their reaction function, that's when we think the Fed could start to cut a little bit, right? But not aggressively,
Right.
because inflation's too high. And so the weakness in the growth data, the sooner it comes, the more disruptive it would be for markets, right? If the data weakens dramatically in the back half of 2024 and the unemployment rate is rising and non-farm payrolls report are negative, then they're going to be able to cut more aggressively in that environment because inflation has come down further, most likely at that point.
Right.
So those will be a lot of the big factors as we go throughout the year. We think avoiding the primary risk of premature cuts means they're more likely to introduce a secondary risk of keeping rates too high for too long and the cuts being too small, which brings in elevated recession risk throughout the year.
We've highlighted a couple of things here. Jackson Hole Symposium. Why is that so important? In late August here, 2024.
The Jackson Hole Symposium is the big academic conference, which is an opportunity for them to justify a long-term shift in monetary policy. So what does that mean, and would they do it, right? So there's been a lot of talk that behind closed doors, the Fed is willing to accept inflation of something like 2.5%, even though they've publicly stated over and over 2% is their target. So you think, Jackson Hole Symposium would be an opportunity for them to take those conversations behind closed doors into the market,
Right.
Bring them to the market. And you start to think about what environment they would even think about doing that. And, in our view, inflation will be in the 2.5 range at that point, but there's no benefit to them coming out and moving the goalposts at that point, because once again, that could introduce the error of reigniting inflation. If they're made all this progress and inflation expectations are at 2, and then they come out and say we're willing to accept 2.5, well, all else equal, to maintain an inflation rate of 2.5, you need more rate cuts than if you were trying to maintain inflation at 2, right?
Right.
So you wouldn't want to do that. So the only instance where we think they would move the goalpost at Jackson Hole would be if the inflation data is saying we're above our target, we should not cut, but the labor market data is saying you need to cut.
Need to. Right.
And they want to save face and justify academically why they are going to cut rates aggressively in the face of inflation above their target. Then they would come out and write a bunch of white papers or whatever about how, hey, it's okay. It's okay that inflation didn't come down to 2 and we're cutting aggressively. It makes sense. There's a reasonable trade-off.
Sure.
That would be the only time we think they would really move the goalposts in that type of a scenario, especially because, you're right into election season.
Yeah.
So that's a factor here as well. It shouldn't be a factor, but it probably is a factor as well, where they don't want to do anything too significant in any direction that might look like they're trying to juice the results for one party or another.
Yeah. So in an election cycle, maybe more of a bias towards less action or maybe a higher bar for action, given that they don't want to appear to be tipping the scale.
Exactly.
Either in restrictive or expansionary direction.
Yep.
Okay. So we've obviously got the federal funds rate as one of the Fed's tools to manage monetary policy. The other tool is the balance sheet. And so we wanted to visit that as well. So just to kind of set the stage here, the Federal Reserve's balance sheet peaked at about $8.9 trillion before this tightening cycle began, sits at about $7.9 trillion today. So still plenty of room for balance sheet reduction. The key question from our perspective seems to be, how is that going to play out, and where could we start to see signs of stress first? And so what do we think about that?
Yeah, the balance sheet is, the Fed is going to speak to it differently. It's going to operate differently than rate cuts. I know at face level, it would seem like if the Fed is cutting rates, why would they still be reducing the size of their balance sheet? That's almost like they're hitting the gas on rate cuts, but still have their foot on the brake in terms of the balance sheet. But they've come out and said that these things could happen at the same time, and they're both normalizing policy. They're trying to get their balance sheet down to a more normal level. So in our view, what's going to get the trajectory of the balance sheet to change, they're running off $95 billion a month at least, or maximum up to $95 billion a month, are three things, two of which we show on this chart. The first one we don't. One is a recession. If the data weakens materially, they have to cut rates aggressively, and there's disruption in treasury markets, and they need to come in and be, the buyer of last resort, then they're going to do that.
And that becomes not normalizing policy. That's a completely different policy, right? So that takes that out the window.
Exactly. Yep. So that's the first thing. Outside of that, what you're watching are two things. One is bank reserves. If the amount of reserves in the banking system get down to a scarce level, which would create funding problems within the banking system, they have shown in the past that they are going to react to that very quickly. The last time we had that was in 2019. You see the blue line, excess bank reserves. As we got into 2019, bank reserves became scarce. What that meant is banks did not have enough reserves to generate new credit, so extend loans into the economy and keep economic growth going, fund businesses, as well as take down all the treasury issuance, right? Basically, banks use reserves to buy assets. Those assets can be loans, those assets can be treasuries, whatever. If they don't have enough to do that, credit systems bind up, and it's bad for everybody. So that would be the first thing. So where is that level, right? Nobody knows. They're only estimates. In the estimates we've seen, and then our estimates where we go back to when the last time there was reserve scarcity and how big reserves were as a percentage of the economy, it scales up over time. We think it's somewhere around $2.5 trillion. We're at $3.44 trillion right now. So that's quite a ways to go.
Right.
So what we think, so we might not reach that in 2024. What we're more likely to reach is the other pain point, is reverse repo, right? So right now there's still $1.2 trillion sitting out in the Fed's reverse repo facility. If that gets down to zero, that in our view would cause the Fed to reverse course, stop reducing the size of their balance sheet. And so why is that? Well, right now, what is reverse repo? What is this? You have money market funds that are sitting on a ton of cash. We know money's been flowing into money market funds for a number of reasons. Get the money out of the banking system, capture the attractive yields, whatever. These money market funds are sitting on a ton of cash. They really want to buy assets. They want very short-term, high-quality assets like 3-month treasury bills. And there just aren't enough of them out there. So they're parking their cash at the Fed's reverse repo facility, and they're getting paid the reverse repo rate, which the Fed articulates their policy target as a range. Right now the Fed funds rate is at 5.25 to 5.5. The reverse repo rate that these money market funds get paid is the bottom end of that range, 5.25. So what that's done is you can view that as funding for new treasury issuance. The Treasury knows this. So the Treasury's come out and they've said that, hey, we need to issue a lot of debt in the future. We're going to issue bills, shorter term debt. Why? Because the money market funds are going to soak it up. money is going to come out of reverse repo. These money market funds are going to put it in this treasury bill issuance. There'll be no market disruption. Once reverse repo gets down to zero, all that extra funding from money markets to fund federal government deficits is gone. And now somebody needs to step in and fill that void. And who is it? It's the Fed, right? So those are your things you're going to be watching. We don't think the Fed is going to be proactive here on the balance sheet runoff. We think they're going to be reactive. They're going to be reacting to scarcity of reserves in the banking system, creating funding problems, or they're going to be reacting to a lack of money market buyers for treasury bills. And they need to step in to, to fix the stresses in funding markets. When do we think that'll happen? Sometime in the back half of the year. It's really tough to say with exact timing, but it looks like we have at least 6 months where this won't be a problem. So, but once we get into the back half of the year, that's what we'll be focused on.
Gotcha. So, obviously just referencing there from a balance sheet perspective, no expectations for something to break in the first half of the year. Similarly, on the economic growth, slowing, recession side, really minimal indications to us that a proactive cut or adjustment will be needed in the first half of the year. More looking for the Fed to kind of wait and see what happens as we get into the second half of the year. With that, we can wrap up with our framework, inflation. Any updates here on our inflation forecasts?
So nowcast type estimates for December inflation, which, we're not very deep into December, but they are ticking up quite a bit for headline CPI. So that gets factored into our forecast. You see the headline CPI line moving up. That's probably the only notable data. We got core PCE last week. That was pretty much right in line with expectations. So that, in our view, doesn't move the needle. And the other data that we received last week was the Fed's beige book, which was somewhat notable. That'll be the last beige book they get before they go into the Fed meeting next week. So it's important that showed slowing in inflation, as well as, more importantly, slowing in economic growth in quite a few areas.
Right. Yeah, absolutely. Economic growth here, you referenced the beige book, also got an update to Atlanta Fed GDP now. This is showing some potential signs of slowing economic growth. Anything we want to add here from a forecast perspective?
Yeah, just over the past week, in line with what was discussed in the beige book, Q4 GDP estimates, nowcast estimates, coming down from 2.2 down to 1.2.
Yeah.
So decelerating pretty quickly, confirmed by something like ISM Manufacturing. So there is now starting to be some evidence that this landing might not be immaculate, and the market's not priced for that. It might be bumpy, and if the data continues to deteriorate, it might be a hard landing. Markets aren't really priced for bumpy or hard landings right now.
Certainly warrant an adjustment in stock and bond prices.
Yep.
Right?
Yep.
We can go to liquidity, kind of painting the same picture here. Anything to add on a liquidity front?
And this reflects our Fed outlook, so our outlook for the Fed funds rate and the balance sheet. So you do see a little higher tick up in liquidity. We've also added a month of data here. So still, though, low liquidity, well below the gray line, and rising, but not nearly fast enough to support a reacceleration in economic growth. Just not enough money being created, right?
Yep, exactly. And then on the recession front, recession signal remains inactive. We talked about some of the slowing economic growth items.
Yeah, the only other thing is the labor market data. We're going to get a lot of labor market data this week. We're going to get the November jobs report on Friday. It's quite possible that the unemployment rate there will be 4% or higher, which could potentially trigger the SOM rule. So that'll be a lot for markets to digest, given that the increase in the unemployment rate would suggest recession has started if the SOM rule is triggered. Whereas the jobless claim data, it's really only continuing jobless claims that are sort of nasty recessionary type environment. Still not a lot of firing going on.
Yeah, still got that labor market kind of frozen in place.
That's right. So if the SOM rule is triggered, say the unemployment rate comes in at 4.1, we would still want to confirm that with initial jobless claims. In order to feel confident that the data is really breaking down, we would want to see initial jobless claims tick up quite a bit.
Makes sense.
Yep.
All right, well, that's it for us this week. Outlook season continues. We'll check back in next week with all the exciting economic data we have coming down the pipe here. And if you have any questions, as always, please feel free to reach out, and we'll talk to you next week.